Hi there, and welcome to this OCR 585 short. And this is looking at extract 2 and the US trade deficit. Figure 2.1 in the extract 2 is about the current account balances of China and the United States. And of course the big story here is the structural trade imbalances between these two huge countries. China has a persistent current account surplus. Of course the current account surplus has fallen since 2008, fallen from more than 400 billion to just under 200 billion in 2013. The USA has one of the world's biggest current account deficits, although as a share of GDP it's actually much smaller than many other countries. And since 2009, although their current account deficit improved during the recession, you'd expect that, the current account deficit has stayed more or less at or worse than $400 billion per year. So this is really the focus of this short video. The US has a current account deficit, and you would expect maybe over time that deficit would fall, particularly if the US dollar depreciated. Now, figure 2.2 in the extract looks at the effective exchange rate index for the US dollar. This is an index of the dollar weighted against the trade that the United States does with different countries. It's based on the importance of the trade in goods and services with particular countries or regions. Figure 2.2 does show that the dollar has been depreciating over the period from 2007 to 2013 on a trade weighted basis. Of course, there's no such thing as the exchange rate for the United States. The US dollar might have been appreciating, for example, against the Japanese yen, but depreciating against the euro. But on a trade weighted basis, the dollar has been depreciating, but not by much. And if you work out the percentage changes, they're actually relatively small. From 2009 to 2011, there was an 8.65% depreciation. The deficit actually got worse then. Maybe talk about the J curve. From 2011 to 2013, a 4% appreciation. So overall, the dollar hasn't fallen very much at all. So the extract clearly states this, that changes in its effective exchange rate did not always have the expected impact on the United States current account deficit. So this is an important phrase in the extract which really needs explaining and dissecting. Why might it be the case that even a falling dollar hasn't done much to put a dent in the size of the current account deficit for the USA? I guess the first point is, as we've just mentioned, the scale, the significance of the exchange rate depreciation of the dollar in percentage terms as being quite small. One reason for that is that the dollar is the world's reserve currency. It's seen as a safe haven. Many people choose to hold dollars. We're in a world of uncertainty and volatility. So that may have kept up the value of the dollar because capital has continued to flow into the United States. You should know your theory that a fall in the exchange rate doesn't necessarily improve the trade balance. Indeed, in the short term, it may get worse. Low elasticity of demand for exports and imports can give rise to the J-curve effect. So pretty much you might argue, for example, that perhaps the elasticity of demand for exports and imports sums to something like 1, in which case an exchange rate depreciation would have no effect on the trade balance. A third point is that a cheaper or weaker dollar increases the price of imported components, raw materials, things which US firms often import before they export. So car exporters in the States might be buying foreign imports, and that increases their costs, which kind of takes some of the competitive gains away. We know that there's been a significant inflow of portfolio investment and hot money into the United States, and not just from China but from other countries as well. And that, of course, in the long run provides a flow of interest and profits and dividends out of the United States, which of course worsens the current account deficit. The really key point really is point 5, that the impact of an exchange rate depreciation on a country's current account balance depends crucially on how open is an economy. In other words, the trade to GDP ratio. So if we think about a country like Australia or the United Kingdom, for example, or South Korea, they have quite high trade to GDP ratios. So the exchange rate is an important, significant variable. In the United States, the trade to GDP ratio is about half that of the UK. It's around 30-35%. So changes in the external value of the dollar are actually less significant for the United States than, let's say, a change in the value of sterling. Sixth point is that the fall in the dollar happened at a time when world trade was pretty weak and slowing down. So it just made it harder for US exporters to sell their produce overseas. Point 7, I think, is a fundamental structural point, that actually the main reason why the United States has a current account deficit is probably a very high rate of consumption, relatively low rate of capital investment and saving, perhaps some relatively weak productivity in some sectors, and who knows, a slowdown in innovation. Other countries may have caught up and bypassed the United States in terms of being at the cutting edge of technological frontiers in many industries. So in other words, you could argue that despite an exchange rate depreciation, supply side weaknesses in the States would prevent any meaningful, substantial improvement in the trade balance. So these are some reasons why the United States continues to run a huge current account surplus despite a slightly weaker, more competitive US dollar. Okay, that's a little short video focusing on one particular aspect of OCR Extract 2.